Welcome everyone to the first TA class being hosted. Previously I always did like a little video here and there. I know it's been a while. Sorry about that. Life's been busy. So we're going to go ahead and host a class. Now those of you who may have watched the training videos that I have on YouTube would already be familiar with these three lines. But for those of you who are not, these are three simple moving averages. Blue is period 50, orange is period 100, and purple or pink is period 200. And so the S squared strategy stands for super simple strategy. That employs these lines and patterns. It's not meant to be the end-all be-all strategy. It's meant to be one that is simple and easy to learn for new people entering the space. It is fairly accurate. There's always the exception, of course, but that's where risk management comes into play. But it'll be a relatively simple one for you to learn off the bat. Jesse, could you mute? Oh, thank you. But it's relatively simple for you to learn off the bat as a new individual, and then over time you can add additional indicators if you so choose that will help you become even more accurate as time goes on. So to go over that, we have our three moving averages. Blue is 50, orange is 100, purple is 200. The app that I am using right now, I created a demo account just for this purpose. With the MetaTrader 4 app and program via the broker Hugo's Way. And you can see that up here in the top left. But this is what I use for my charting, what I use for my trading. I drew some lines on here for you guys to see, but we're going to start from the beginning. Zoom in. Zoom out a little bit. There we go. All right. So what I wanted to show you guys first and foremost, because I know the market's been crazy the last couple of weeks, and it has everyone kind of panicking a little bit. Some people have been losing a lot of money. Some people have been making a lot of money if you're shorting. But all in all, what I wanted to share with you guys is that this is nothing new. This is what Bitcoin has been doing since its inception. And we're going to take a look here at that. So you can see MetaTrader 4 only goes back as far as like 2011 for the Bitcoin chart. I think it's been around a little bit longer than that, but you can see here when it first started recording, Bitcoin was at 73 cents. What a steal, right? From there, Bitcoin then ran up to an all-time high of $31.86. You can see that afterwards it declined all the way back down to a low here of about $2.17. I can imagine with such a high percentage decrease right there, there was a lot of people who lost a lot of money if they bought up here near $31, right? Lost a lot of money. A lot of people said, oh, it's dead, right? It's a scam. Nothing's ever going to come of it. But I want you to pay attention to the pattern here, because the patterns are what drive the market. It's a subconscious thing. It's also based off of algorithms that bots use to trade. And I'll get more into that here in a little bit. But look at the pattern. So runs up, comes down, small run up, and then goes back down and sideways for a while. Let's take a look at that. So here we go. So it went sideways, as you can see, from February of 2012 all the way until, what's this day right here? All the way until May of 2012. So that was a several month period where it just went sideways. Had that big drop, came up a little bit. This is what's known as a bull trap, right? Because after such a long period of down, the people shorting or the selling get tired, right? And then people who were looking for an entry say, all right, this is a good price, right? You know, it's now down X amount from its all-time high. This would be a good spot to scoop up some Bitcoin, right? So they start buying, right? And then the people start selling again, more sell pressure. That's known as a bull trap. After that sideways consolidation period, we then see, oh, went a little too far. It began its next run, which, if we zoom out a little bit, this was that first peak that we were looking at, right here, the one that went up to 31 and change, which was a massive increase for the time, from 73 cents all the way up to $31, right? With then a massive decrease all the way back down to like $2. Sideways action, but then it went on its next run, which went from, at the beginning of the run, like $14, up to a high of $265. That is a giant increase. And if you were to make yourself a little trend line off of that, and we're going to see where that ends up in the future. But then when you look, this one did the same thing, where after the run, it had that sharp drop. This time, though, it had a much shorter period of consolidation after the secondary run that came after it, which is a smaller run. Sideways for, what was that? About a month and a half before it continued on its way. Now, remember that line that we drew off these two peaks? That was resistance. But then when it broke past the resistance, it was treated as support for the bottom of the next one. I want you to remember that. Once you break past a resistance, it is treated as support until it breaks underneath it. So you'll usually bounce off. And if you see here, here's our first moving average coming into play, the MA50. It also acted as a moving dynamic support to then slingshot the price back up. But you had, from our peak here of the first pre-run, about $265, to a high of $1,173. So you see how each time it's doing its run, it's almost like a multiple of the first one. And this brings us to 2013 through 2015. Just like that very first one that we looked at, after that run, it started going down, and then it hit a point of consolidation where it went sideways for quite some time. And if we look here, that lasted over a year. During this point, we see our 200 moving average appear. Now, the moving averages, when it says period 200 for the new people who may not know, it takes the weighted average of the last 200 candles. So up into this point, to this date right here where we see the moving average 200 appear, that is 200 candles since the beginning of the chart. So that's just how those moving averages work. They take the weighted average of the last X amount of candles. This one is 50, the last 50 candles, the last 100 candles, the last 200 candles. So these provide for us moving dynamic support and resistances. And you can see that. See how it was consolidating right here around the orange level before it finally broke underneath it, at which point it then went to test the pink one. Your blue is the weakest, your orange is a medium strength, and the pink is a strong strength, support and or resistance, depending on where the candles are. If the candles are below, it'll treat it as a resistance. If the candles are above, it'll treat it as support. And you can see here, during its sideways process, it tried to go up, but was met with resistance by the MA50, which pushed it back down to the MA200. Once they got close enough together, a small movement was able to push it past the MA50, at which point it met resistance here at the MA100. But then when it broke past it, it then treated it as support. So from there, now it was above all the candles. And I want to point out something. These are what's known as moving average crosses, and they can be indicative of upcoming bullish or bearish momentum. I'm going to show you what I mean by that here. So you have a cross. Let me see if I can insert a little arrow. We'll put it right here, pointing at this guy. Well, that's a very tiny arrow. All right, but there's your cross. And from there, Bitcoin began its next run. The run that we all first got interested in Bitcoin with, right? When it ran all the way up to almost $20,000. It was preceded with that cross on the weekly chart of the MA50 crossing back over the MA100. So when you have blue, orange, pink in that order, that is a bullish market. When you have the blue under the orange, that is a bearish market. And then especially if the blue drops beneath the pink. So from there, we have our same multiples, where we have our previous Bitcoin run up to the 1100 region. Now, the multiple takes us up to 20,000. 1 second, let me just verify that we're not hitting a room cap. All right, cool. Now, after the 20,000 point that we hit here, I think it was more like 19,800. We saw the exact same thing that we saw in all the previous cycles, where it began to descend. First, it caught some support at the MA50, but then it fell underneath it, which meant it was going to go to the MA100. Tried to get back above. Now this MA50, which used to be support, is now resistance. So it went down. But I want you to see here that the MA200 caught it as support. Because remember, it is the strongest. Out of these three, it carries the most weight. And it helps if I picture it kind of like the candles are a planet orbiting these lines of gravity, where they kind of circle around it, more like an orbit instead of, just straight up and down. Almost like a living, breathing, moving thing. But anywho, moving on. So as you see, caught by the 200, which was enough to slingshot it up, and then treated as support here. You have a cross right here where it starts to go back into a bullish market. But then, of course, we had the COVID lockdown, which caused one last spike down. Now, because even though this candle closed beneath the MA200, but the following candle closed back above it, we knew that the MA200 held strong. Which, if you were a trader during this time and you saw that, that would be your indication to buy Bitcoin, right? Kind of like a quick loop around the MA200 is what the candles did there. Now, if we zoom out a little bit, we can see that the lines here, I'm going to draw another one for you. The bottom of this candle on up. And we can see that Bitcoin made a pennant formation. And it was going to range inside of that pennant. You can draw lines once you have two tops and two bottoms. Because you need 2 points of reference data in order to draw a line. Now, my patterns video goes more in depth about patterns, so I'd recommend giving that a watch if you want to learn about the different patterns and how to mark them. Now, moving in right here, we see once it got its support, it meandered its way through the various moving averages above it, but then kind of rode along the top of the MA50 until it got squeezed outside of this descending trend line. So that trend line, just like the moving averages, acts as resistance when the candles are beneath it. Once it got past it, it did a final, came back down to kind of test and see if this area was now support. Once it saw that it was, it went on its run. And just like all the previous ones, which were just multiples of the first runs, this one was a multiple of the last run to 20K. And if you were one of the individuals who was in my Facebook Messenger trading group before I migrated here to Discord on June 25th, 2020, I let everybody know that it broke out. So that would be in this area right here. I let everybody know that it broke out, and then it was targeting between 45 to 55K based off of the multiples from the previous runs. I can't remember which video it was that I have on my YouTube, but I actually pointed out that Bitcoin was in a rising wedge formation and that it was likely to go down, which, of course, as we all know, it did. But aside, let me get rid of those lines real quick, because we do not need those. I usually do this from my phone, so you'll have to forgive me. I'm a little slower doing it from the computer. All right, there we go. All right, because we're just focusing on the moving averages this time around. So as you see, once it gets too far away from gravity, i.e. your moving averages, it's going to run out of steam and get pulled back down. And one of the things that you'll notice as you have these moving averages on your chart is that it likes to test them in order. So if you have blue, orange, pink, right? It'll first test your blue. 9 times out of 10, it'll hold as support. When it tests it a second time, it will go to test the next one. Then the next test would be the third one, which if you are in an overall, and by overall I mean years, if you are in an overall bullish market, the MA200 will hold. But because it is attracted to the strongest gravity, if you will, between the 50, 100, and 200, it'll test sequentially, which means I am expecting over the course of the next couple of months, if we were to say drag this, that's not the line I was trying to make, but if we were to kind of drag the moving average out, right, based off of extrapolating data, I am expecting over the next couple of months, just like it did with all of the previous cycles, to test that MA200. Every single previous cycle tests that MA200 because that is where full capitulation occurs. It's fallen far enough that most your retail traders who aren't holding on for dear life have decided to exit the market. But it's also where new blood looks for buying opportunities. And that is where, if you're in the trading Discord, which you are right now, you'll see that my price range prediction for Bitcoin has been between about 20,000 to about 24,000. See, there's 24,000, which it would hit September, right? If it drops faster, you could see like, the 21,000 range or whatnot, and it could be, as soon as, a week or two from now. It all depends on what the market chooses to do. But if you have your calculated area of entry, then you are able to just patiently wait for that. If you had purchased when, in the 30,000 region when Bitcoin was going up, and you saw the rejection here, you would know to go ahead and sell, right? Because it's going to go and test the stronger moving averages. So that's kind of my personal thoughts on the time range. But I wanted to point something out to you guys. When you're looking for entry, first it tests it and rides along it, and then it briefly spikes beneath it. Now this spike beneath is usually around the same region as when it first tests it. So if I were to speculate, so to speak, on where this would go here, do I have a drawing tool? Let me see. 1 second. Again, I usually do this from my phone, so you'll have to forgive me. I'm not 100% sure if they have a drawing tool here. I don't see one. All right. So what I'm kind of expecting it to do is it's going to work its way down, right? It's going to kind of ride along this. It's going to come back up until it hits where this orange moving average has now started to curve down because the price is beneath it, right? So it's going to come back up. It's going to hit. That will be your bull trap, quote unquote, just like in the previous runs we see here. At that point, it will come back down, briefly spike beneath the MA200 and go back up. Assuming, of course, it keeps doing everything that it has been doing since its inception. You can even see spike beneath MA200 here, which just so happened to be relatively in line with the testing point that it initially did for the MA200. If it falls beneath the MA200 and the following candle does not take it back above it, I personally would start being concerned. But throughout the entirety of history, that MA200 has held strong, and during spikes beneath it, the following candle closed back above it. So if you're looking for long-term entry into Bitcoin or other altcoins, that is where you would look to start purchasing. So sit on the sidelines, wait, and then from there, you can start seeking your entry. Now, bear in mind, none of this is financial advice, yada yada. Just have to throw that disclaimer in there. Don't sue me. Yeah, I'm just showing you what I see in the charts. I want to briefly touch on candles. This is a good spot. Kind of to discuss with you guys what information you can get from a candle, because this is important stuff. So obviously you have your bullish candle, you have your bearish candle. If for bearish candles, the price opened right here, right? That's the beginning of the body. During it went up a little bit, that's your top wick, then it came down, that's your bottom wick, and then it came back up and closed. So your wick shows the price movement that's outside of opening and close. Your body shows the price movement during the range between open and close, right? So you can see if there's a lot of pressure one way or the other, because if your candle, its open and close is relatively close together, that typically signifies overall indecision. Bulls and bears can't really agree one way or the other of where it should go, but you can see a very wide price range here. Now, there are official names for many different types of these candles. You've got your inverted hammer, you've got your morning stars, this guy right here, and we have those listed, I believe, in the pattern example room, or it might be in the resources room. Either way, those candles are listed in there. So you can study them to kind of learn a little bit more about them. But these give you a general overall view of what people are thinking about the market. If you've got just a lot of bearish candles, you can see if the bulls are fighting. If they stop fighting and these wicks start getting smaller and smaller, then you know that it's probably still going to keep going down. If you're at a point where you're going down, but you have a lot of wick support, you can assume with relative accuracy that means the bulls are still feeling strong and they're going to still keep buying. If you see a lot of bullish candles, see how the wicks are not very tall on top? Wicks on top equal bearish pressure, wicks on the bottom equal bullish pressure. So not very tall wicks here. There's not a lot of resistance from the bears. As the price starts increasing, you see those wicks getting taller, right? Because people are like, all right, Bitcoin shouldn't be worth this much at this point. It's gone up too much during this time, so I'm going to start selling now. And as more people start doing that, it starts facing more selling pressure. So if you know the why, it lets you arrive at your targets a lot easier, right? Let's see here. So I wanted to draw something. Where to go? And I want so this simple moving average strategy, you can use it on any chart. Here's gold, for example, and you'll see it behaves the same way, where it'll treat them as supports and resistances. And if you're in an overall bullish market, it'll stay above the MA200. It may briefly dip beneath it, but then it will go back above it. When you start to enter bearish territory, it can sink beneath it. You see, gold's good for showing off the crosses, so I'm going to show off the crosses here. See when MA50 dropped beneath the MA100, so when blue crossed under orange, gold began to descend. Yes, it had a spike back up, but blue did not cross back over orange, which means it is still a bearish time. Then it fell beneath MA200. It dropped all the way down. See, when the first cross occurred at the price of $18.98 per troy ounce of gold, if you had entered a short here with no stop loss, at one point during that spike up, you would have been in the red. But overall, gold dropped over $200 per troy ounce from that cross to the bottom, where then it was very nice. See, the reason why I like gold so much for training new people is it respects a lot of these rules. It respects the moving averages. It respects patterns in most instances. The only exceptions for that are during very crazy news. Just as an example, you had this big drop here was, where was it? Okay, so this right here, where is it? Where's the date? All right, see this big spike down here that just took it right through all the moving averages without any bother of consolidation or resistance or any of that nonsense, just a very sharp drop. That was during COVID lockdown. But then once sentiment started recurring, it went back to respecting the testing order. It went back to respecting patterns. We're going to draw out a couple patterns here real quick. One of my favorite ones for trading is cup and handles. For a cup and handle, you mark your peaks. So we're going to focus on this for a second, just because cup and handles are very important. So you got your two peak regions. I can only make, I can make angled lines. Hold on. So let me get rid of that horizontal line. 1 second. Delete. There we go. All right, so angled line. You have your peaks. We have our peak here, and then this was the third peak. Cup and handles, they are quite literally a cup with a little handle on the end. The way to measure a pattern like this, and again, I go more into depth on this on the pattern video, so I'm not going to spend a whole lot of time on the math and showing you how it ends up where it ends up, but you measure from your trend line, also known as the lip of the cup, down to the bottom of the cup. Then you add that amount on top of the lip line, and that's your target take profit. So you measure this distance and say, okay, measure out what that distance is. That would be where I take profit. So just as an example for those patterns and how beautifully gold will respect patterns and the moving averages. I mean, just as an example, you can see even during choppy times, it respects it very well. And something I wanted to point out that I actually had conversation with an individual the other day. Let me see. It's going to be harder to see that on the overall time frame. So let me find a shorter time frame. Go to the end. There we go. All right. When you have instances where the price spikes up very quickly, and there's no consolidation period underneath the moving average it's trying to break, you can expect that most of the time it is going to fall back down beneath that. You got to have your consolidation period where it's testing the resistance and then breaking the resistance before you can see a sustained move upwards or downwards. So you see there was a pattern of consolidation here over the course of an hour and a half, because this is the M30 chart, so each candle is worth 30 minutes. It had that period of consolidation, so it had a sustained break above where it hit the MA200, where then it consolidated, etc. So pay attention to what it's doing when it breaks through one of these moving averages. Let me switch back to my weekly chart and then go back to gold. So just to reiterate, your dynamic moving support and resistances, and you can see how gold respects that. Here's your support, right? Here's testing of the support until eventually it falls through, which means since it tested here, the next one it wants to test is orange. So it'll test it. Gets trapped between the two because it's ranging between this moving resistance and this moving support. Has this really crazy spike, which then crashes back down, yada, yada, yada. Gets support from the 200 region. So if you add these indicators and you spend some time looking at your charts, you'll see how well certain things respect it. The reason why I like gold is because it tends to respect it. Again, sans crazy news events. Right now, the dollar is going on an absolute insane run, but even still, you still see it trying to test that resistance there, failing, going down. Right now, it's below the MA200, so we can relatively theorize that, all right, let's take our bottoms here, and this is just a wick. I tend to ignore it if the wick is that tall, because that tells me that's some crazy news event when it comes to gold. So I'd go to the next bottom. So we draw out our little lines. Ignore the tall wick. All right, so you see right now gold is underneath support, both with the MA200 and our trend line here, which means it's going to have a difficult time getting above this price region right here, which I believe is like 1850. Let me see. Yeah, this price region is like the 1830 region, right? So it'll probably come up here, consolidate a little bit under this, before returning to go then test the MA 100. So just to kind of show you the general ebb and flow of things. So just to briefly recap, and then I'm going to check and see if there's any questions so far. The markets today, while scary, is nothing new. This is what Bitcoin has been doing since its inception. If you've been in the markets for a long time, you just kind of ignore it and wait for time to enter. If you're new, it can be very scary, especially if you've only been in the markets for about a year, right? Because if you've been in the markets for a year, which in DeFi is a long time, you would have caught, Bitcoin's rise up from this area. If you've been in here for 2 years, right, that takes you back to 2020, which was the beginning of this bull run. So you're used to just always having profits flowing. So when they're not, it can be daunting, it can be stressful, it can be scary. So I just want to reassure you guys and let you know that it has been doing this since its inception. This is nothing new. You just wait, be patient, look for entry once into the markets. Once Bitcoin gets near that MA 200, has a nice little bounce off it. When you got a candle that touches it and then a candle that closes above it, that's generally where I look for entry, right? Because it's shown that the support is holding. Even if it then does its brief spike beneath the MA 200, like it also does throughout history, it still only takes you back basically to your entry point, right? So it's still a good entry point if it bounces off the MA 200. But if you miss it for whatever reason, just wait a couple months for it to spike beneath it, and then that would be your last call before the next run, which would be a multiple of this high, just like this high was a multiple of this high, and then this high was a multiple of this high. So if you that would be your final boarding call, so to speak. All right, let me take a look here, see if we have any questions in the voice text room. Yes, Ultra. It's MetaTrader 4 with the broker Hugo's Way. Ultra says, I've said this many times over the years, only two things are certain in crypto: maximum pain. Crypto is cyclical. Well, it doesn't have to be painful. If you were one of the individuals who watched, I can't remember if I think it was the pattern video in the training room. When I made it, Bitcoin was in the 60,000 region. I believe it was right around this region that I made the video. And I actually mark out the fact it's in a rising wedge and that we have a crash incoming. I've been talking. So when I share with people what my sentiment on the market is, I give two options. I give you your bullish option and I give you your bearish option. Because there's always variables. You never know if there's going to be extraneous news that comes in that suddenly flips it to a bull scenario. You never know if there's going to, the world's going to fall apart and it's going to change into a bearish scenario. So I give one of two potential outcomes, because if you prepare for both outcomes, you can go in with a plan. You're going in knowing that, okay, if I buy here and it's a bullish scenario, I should look to exit and take profit here. Or, if I buy here anticipating a bullish scenario and it flips into a bearish scenario, I know immediately to cut my losses and wait for better entry instead of buying and then riding the entire, slip and slide all the way down, right? Because that's where a lot of people lose money. It is better to close at a small loss than to let yourself just hold, right? It's easy to hold because it doesn't require you to make a decision. It doesn't require you to have a plan. I want to say, probably about 90% of the people that I talk with, they don't have a plan for if the market turns on them. They're purely driving based off of hype. So when it starts going down, they're like, oh, buy the dip, buy the dip. Well, yes, but have you calculated where this dip will go to? Or are you just going to be throwing money at something that's going to continue dipping? By calculating both the bullish and the bearish potential out scenarios, you can arrive at a targeted bottom. So when it starts dipping, you know to get out, cut your losses, put your money on the side, and wait for the calculated entry. Let's see. Plastic asked, novice here, how long do we anticipate this downtrend based on historical? Sorry if answered already, was late. Yeah, so I am quoting a range depending on how quickly it gets down to MA200 on the weekly chart. It could be, we could see our bottom as soon as, I would say, as soon as within a month, or we could see our bottom as late as I want to say September, October, that area. But again, it's based off of the moving average, where it will be at that point in time, which is why I give a range, right? I say targeted bottom is between 20 to 24,000, right? Because here's your moving average currently, it's sitting at 21, but we all know that during strong periods of bearish momentum, it can sometimes spike beneath that, right? Now, throughout history, we generally see the first time it touches it as stopping at it. It doesn't spike beneath it. But then the second time it touches it, which shows you the last bottom before the run, it'll drop beneath it, right? So I expect it to touch probably in the next month or two, which would, let's see, if it's next month, it would be a bottom of around 22K. If it's the following month, the bottom would probably be around 23K, right? So either way, it's not a bad entry point. But then, it'll come back up, it'll briefly spike beneath it, which would be your last call to action. And depending on how quickly that happens, it could be as soon as January, it could be as late as, like March or April. It's really dependent on a couple of extraneous factors. So don't try to time it. Try to calculate it. Calculate what those numbers could be, not time of entry, right? Because it doesn't matter what the timing is. The only effect that timing would have is it would raise that bottom, right? Because the moving average 200 is still taking into account the last 200 candles, which as the part back here falls off because new candles are being created, these peaks here will have more weight. So the moving average 200 is still going to be going up even though the market's currently going down. Your MA50, yeah, it's going to be going down. Your MA100 is going to kind of curve and start to kind of flatline, right, before the price begins to go back up again. So you can kind of anticipate the moving averages and how they're going to move, so where you could see resistance, right? So if I know that the MA100 is going to kind of start, it's going to keep going up a little bit, then it's going to kind of start curving outwards because now it's factoring in more of the price that's down beneath it. I know, okay, after we bounce off MA200, could probably see some strong resistance in the 37 to 38K region, right? Because that's where I anticipate the moving average 100 will be. And if you look at it, your 37K region was a previous support level, right? 38 to 40K was a previous resistance level. So, and it's just funny how that will line up with your moving averages, which those kind of, if you chart out kind of like the arc, the curve for it, where it meets up with those support and resistance levels, those horizontal ones, that kind of calculates what time frame you can look at too. So if you know that this is dynamic and moving, when it meets that level, you know that's probably going to test to that region. So that gives you a time frame guesstimate. It's not going to be accurate, but it's a guesstimate, right? But yeah, let's see here. Sorry, I had a bit of a brain blank. Happens to me occasionally. So yeah, that's the cyclical nature of crypto, how it interacts with the moving averages, which if you want to learn more about those, give the strategy video on YouTube a watch. How it plays with patterns, there's a video on that as well. You've got all sorts of patterns. You got your head and shoulders, you got your cup and handle, you have inverted cup and handle, inverted head and shoulders, you've got your pennants, your flags. As a trader, you should know these patterns. If you're a trader and you don't know these patterns, you're doing yourself a huge disservice. Bots, like the trading algorithms that big money uses, will utilize patterns like this. They'll utilize support and resistance levels. They will utilize moving averages. Like I actually deconstructed someone's trading bot because I was curious to see what they were looking for, and it was actually based to trade off of the MA50. So like this trading bot for this big business used a moving average 50 to trade. So, this basic strategy allows you to kind of trade with the big money. Because let me tell you right now, retail traders do not have the firepower necessary to move markets, right? Yeah, you see some more retail traders affecting markets when it comes to things like GameStop stock, AMC, yada yada, the meme market, so to speak, because big money doesn't want to get involved with meme markets. So like Shiba Inu, Dogecoin, any other meme token, big money's not going to get involved in it. So retail traders have more power there. But with things like Bitcoin, we have no power here, right? Big money is what's going to move it. So you want to trade with the big money. If you can do that, you will make money. If you are trading against the big money, you will lose money. There's no real question about it. That's just how it will be because they're the ones moving the market. It doesn't matter how many times you decide, Bitcoin is coming down, I want to buy because it's going to go up, right? It doesn't matter what your sentiment on it is. What matters is the calculations, the patterns, and the moving averages, because that is what big money uses. So it's not going to stop doing what it's doing until it reaches that calculated thing, right? I see a lot of traders, they'll use things like Fibonacci, right? Which you can do. That's not a bad thing to do. You can take your bottom here. Why is that yellow? I can't see that. Holy cow. 1 second. Can we change this color, please? Why is it yellow? That's a terrible choice. We're going to change this to something that we can see a little bit better. Let's thicken these lines up a little bit. Makes it a little bit easier to see. All right, so you can use Fibonacci levels too, right? You got your bottom to your peak here, and you can see that these moving averages will generally intersect with points of these Fibonacci levels. Sometimes they will actually line up with where the testing is. And you can see with this Fibonacci level here, let me point this out. See how the bottom here kept testing it? And then this was resistance right here. So you can use a Fibonacci indicator. And let me remove that one for a second because I just delete. All right, I'm going to draw a new one. It's going to be from the bottom here to the most recent peak. All right, there we go. Sorry, drew it wrong the first time. Happens. But yeah, so you see supports. Let me grab my little pointer. You see resistances, you see your support points, and see how they all just kind of line up into these neat categories. The moving averages, they play with that, right? Because they're almost like like I keep saying, they're a dynamic moving support and resistance level, right? So you can utilize the Fibonacci's as well. You draw it from your lowest point, drag it up to the highest point. If you're trying to calculate bearish, you would draw it from your highest point, your most recent highest point, to the lowest point, right? So we have our fib level here. This is what some people are using, by the way, to try to say that it's going to go down as low as like 6K. I personally don't believe it's going to go down that far. Institutional money is all chilling between 20 and 25,000, so I don't think they're going to let it go down that far. They want you to lose money. They don't want to lose money, right? So that's why I believe that the MA200 will hold as it has throughout history. But if you see here, where does your 61.8 Fibonacci level intersect with a projection of the MA200? January, right? So if you want to try to use that to kind of calculate a potential time frame for it, you could. But that's, just as a little preface here, that is not super accurate. But yeah, I don't actually draw Fibonacci's. I'm drawing it to show you that it is something that you can use, but I personally don't use them. The only thing I use on my chart is literally these 3 moving lines, and that's it. Like I do it all through my phone, so if I'm looking for a trend line or something like that, I'll just tilt my phone at an angle until the peaks line up, right? I know it's silly, but you don't need to overcomplicate things. A lot of people will overcomplicate it. They'll draw all sorts of stuff on their charts, and it just becomes a mess, and then you can't see the forest for the trees, right? Because you're so busy focusing on all these different indicators. Find a couple that work well for you, and just leave it at that. There's no reason to get overcomplicated. Let me clear these lines off my chart. Because I'm going to basically just kind of show it to you as I look at it. Delete all. There we go. And that's that. But yeah. Let's see here. Aha. Yes, I can do that. So, since I don't do my trading on my desktop, yeah, I fired up a demo account just to be able to show and stream to you guys. So this is a demo account. So let's go ahead and switch down to a smaller time frame so we can see the price moving. We can see all of that stuff. So this is the 5-minute chart. Let's go crazy. Let's switch it to the 1-minute chart. Obviously, I never recommend trading on the 1-minute chart, but as you can see, it still does respect a lot of these moving averages, but the smaller the time frame, the less accurate it will be, because it has a lot less data to pull from, because now the MA50 is only pulling from the last 50 minutes, right? Less than an hour. The MA100 is pulling from the last 100 minutes. MA200, last 200 minutes. So it's not going to be as accurate. But let's say we wanted to go ahead and make a trade here. Let's look for our entry. We can draw some lines. I'm doing that just to kind of help you guys visualize. You've got your 2 points of data. You got your 2 peaks here. You've got your 2 lows here. You see it came out and it tested. It's above everything, which is bullish. So we're going to place a trade. I'm going to say, let me find it real quick. Again, I do this all from my phone. I don't really use this. Where is it? New order. There we go, F9. So we have our order here. We want to place in a buy. Leveraging is what you would enter in volume. It's also known as lot size. A 0.01 is no leverage. For every penny Bitcoin goes up, you'll make a penny, right? For every penny it goes down, you'll lose a penny. If you wanted to do 5x leverage, it would be a 0.05. You could enter your stop loss. So let's say you want your stop loss to be if it falls beneath the MA50, right? So we could set that very easily. I believe that right there is, let me see, can I pull this up? MA50, 29472. So we'll go ahead and put in. Yes?
Cyril, we can't see whatever this window is.
Oh, it's a new window. 1 second. Let me just change my screen, change windows. All right. Now you can see the order window. Sorry about that. So yeah, now you can have your stop loss. This is your lot size, the volume. That's your leverage, right? 0.05 is 5x leverage. Then you've got your stop loss, and you got buy or sell. So in this case, we can see you have, well, you can't see it at the moment because I would have to switch back to that screen, but it shows a little kind of like the price action right here. Let's go ahead and put in a buy and see what happens. Boop. So your order has been placed. We'll hit OK. Now let me switch the window back. All right. So you can see we have our buy. Let me zoom out a little bit. All right. So because of spread on Hugo's Way, and because we put our buy in at that intermediary peak right there, just as an example, because of spread, it placed our buy trade up here. Our stop loss is here, which is supposed to be under the MA50. Yes, I know. All right, there we go. So let's move that under MA50. Now our stop loss is under there. So if Bitcoin were to come underneath the MA50 and hit our stop loss, it would close the trade at a loss to prevent further loss. So now we have our trade here. I'm trying to zoom out a little bit so we can actually see it because it placed it higher up. There we go. Now we can see it. So once it crosses our buy, we will then be in profit. We can look at our view. Where is it? How do I get it back? Here we go. Window. No, not there. Yeah. Hugo's Way, unless you close it, and I can't remember how to open it back up on the desktop, but on the desktop, Hugo's Way will have a trade, open trade thing at the bottom where you can see how in the red it is or how positive it is. Terminal. There we go. There we go. Got it open. Again, sorry, not used to desktop. So we can see our trade here. We see the leverage size. We can see what our current loss is, right? Because with the bid and ask, basically bid and ask is what they're selling it for versus what you are buying it for. That's how like Forex markets and whatnot make their commission, and Hugo's Way is a Forex broker. So if you enter a buy, it has it up higher than what the actual price is. If you enter a short, it has it lower than what the actual price is. So as we see, based off of breaking out of this pennant here, and then testing the support, it is going up, right? So now our trade here is in profit $11. Oh, and of course it fluctuates around. But $11, $21, $22, $24, and so basically as Bitcoin is moving, our 5x leverage trade is just doing its thing. So that's an example trade there for you. So time frames. Let's go over time frames a little bit, because I see that was a question there from Miss Mindy. When I am looking for trades, I generally use the 4-hour chart. I'll use the 4-hour, the daily, and the weekly. And that's where I'll do my charting. That's where I'll look at my moving averages. I'll look at my patterns. I'll look at where I'm looking to enter. Then once it starts to get close to that region, I'll switch down to M30, right? Where I can see like short-term sentiment. And with short-term sentiment, I can say, okay, we had our peak here, draw that down if we want to. Here's our bottom there. Stupid Hugo's way. Here's our bottom here. That's a falling wedge, right? So we're like, okay, if it breaks out of that, it's probably going to go up, right? But right now, you see on the, let me get rid of these lines so you can see it a little bit better. One moment. Delete all. Thank you. So you see right now, it's kind of stuck in between these moving averages. It's stuck in between MA50 and MA100. And so our trade is ranging right in that area. Now, MA50 just so happens to be right around the same point our buy order went in. So this would not be a trade that I would recommend normally. You would want to wait, right, until it gets above and then tests with a successful bounce. So you can see over here, MA200, it gets above, but then it closes right back underneath it. Gets above, closes underneath it. Gets above, goes to test it, but the test fails. It just keeps going back under. It doesn't bounce back up and have a candle close still above it, right? It tests it and it falls beneath it. So when I'm looking for entry, for the perfect entry on a trade that I've been keeping an eye on and looking at entering on like the H1, H4, and daily, I would pop down to the M30. I would wait until I see it, break the pattern, test it, or get above the moving average that's strongest, that's above it, test it, and then successfully bounce off it. That's when I would enter. Does that mean I'm potentially missing out on, the movement difference between what may have been the bottom and where I entered? Sure. But on the flip side, if you enter before you get that confirmation, it could still keep falling. Like imagine if I was waiting for an entry that I calculated on like the H4 or the daily chart, and I flipped on down to the M30 and I saw it break the MA200 and entered in a buy. That would have been bad. You've got to wait for the confirmation. It's worth risking missing out on a bit of a price difference to manage your risk. And I actually see a pattern right here that I want to point out to you that kind of tells me that was the interim bottom. This is an inverted head and shoulders. Here is one shoulder, here's the head, and here's the second shoulder. There's your neckline, right? So you would measure the distance between the top of the head and the neckline, And then after successful sustained break over that trend line, you would add that price difference as your target. So let's say it went from like 26,800. Our neckline here is at 29,500. So that's about, what was it, $900 difference. Let me just double check. Or no, that's more than $900 difference because it was 26 versus 29. Yeah, so you would take that difference and you would add it to your, after it breaks out of the trend line, right? And you can actually see it was treating that same trend line kind of as a support region when it was testing it repeatedly. See, test here, test here, test here. Then failed the test, got beneath a little bit, but then it got back above it, which tells me that this trade is still good. Like if we were currently trading off this head and shoulders here, you know, we entered after it broke, that's actually pretty much where we put our test trade, was after that break right here. So this gives you an idea kind of what that trade would have looked like. If you had entered after that break, you know, you would have gone up, let's see, where's our break? 29,700, went up to a peak of 3,100, or sorry, 31,000, and this is 29,700. So, you know, that was good little movement there. That was like $1,300, right? If you were running that with 5x leverage, you know, you'd probably be a happy camper. But because we got back above that trend line here, I still consider this trade a good one. So even if you didn't exit with profit here, right, and then it came back down, once it got back above that trend line, I would still consider that trade to be in motion, right? But you would have, if you were following this strategy, if you entered here, right, after it broke out, and you're in your trade, you probably would have placed your take profit at the MA200 because you know, based off this strategy, that that's a very strong resistance level. Worst case scenario, if you didn't want to use a take profit and you wanted to use a stop loss on the trade, you would have placed it at the moving average beneath where you're currently at, right? So you would have had your stop loss here at the MA100. Or you would have had your stop loss once the MA50 crossed up and over it, you would have put your stop loss at the MA50. Let me check for any questions. Let's see. And does anyone have any questions about this so far? Any more fail charts we can learn from, stuff to avoid? Yeah, let's take a look. All right. So we're gonna go ahead and just close out our. Well, actually, no, we're not gonna close that out. We're just gonna let it do its thing for the rest of this video here. Our little test trade. All right, so fail charts. I'm assuming, correct me if I'm wrong, but you're referring to like a pattern or a trade that fizzled out and like didn't do what it was supposed to do. Is that what you're referring to? Bull run into bears run, I guess. Okay, so basically where they like are kind of fighting back and forth. Let's take a look. All right, we're on the H1 chart here. Let's see. So with these moving averages, something I wanted to just kind of point out while we're looking at it. As you know, anytime we get too far away from one of the moving averages, it will try to come back down and test it, right? You can see that here. You can see it through general bull movement. It'll come up and then it will go sideways or down until it hits that, come up, go sideways or down until it hits it, rinse and repeat. Same thing for bearish movement. When it gets too far away, too far down from them, it'll go sideways or up until it meets it. Gets too far away, sideways and up until it meets it. So you can actually swing trade based off of that. Like see, even during big drops here, like what happened on May 6th, big drop, sideways until it hits it. Once it hits it, you can look for a short opportunity, right? Let it go down, take profit because it's getting too far away, sideways and hit it. Trying to find fail example. I might have to switch to a higher time frame for that because the last while it's just been bearish. Okay, so this is a good one, I think. We have our, wait, where'd it go? Ah, there it is. So this is one right here where it didn't even bother testing any of these as support. It just crashed right through it. See that? What date was that? September 21. Trying to remember what happened news-wise. I think that was when inflation reports were coming out. Either way, yeah, so it didn't even bother testing it. So if you were in a trade and you didn't have your stop loss in underneath that first moving average that was beneath you, your trade would have very quickly turned sideways. Like let's say you entered here when it came down and tested MA50 as support, because that's what it did, tested it as support right here. Next candle closed above it. So let's say you entered a trade here and you didn't have a stop loss in and it just crashed through like that, right? Now your trade is super in the red. I mean, you would have entered around 49,000 region. It went down to like 43,000, so that's like a $6,000 difference. And then from there, it never got back up to your entry price before then going all the way down to 39,000, right? So if you had any kind of leverage in that, you would have been losing your ass on that, right? I've seen people, like I frequently, and don't do this unless you have a very healthy account size, but I frequently trade like Bitcoin and Ethereum with 75x leverage, right? Which is really high for cryptos with how they can swing and move. But yeah, so that's kind of an example where things can go sideways, which is why you use risk management. You have your stop loss in. If you enter in a trade, like let's say, as this is a perfect example, it came up, it got above the moving averages, it went sideways, kind of testing that region, making sure it wasn't going to crash back under. You could have bought here, right? Then when it goes up to here, or starts increasing a decent bit, put a stop loss a little bit above where your trade is. Because then even if something like this happens, you're not going to lose. If you entered here and then when it started going up, you put a stop loss right above where your trade was entered, it would have closed you out basically flat. You wouldn't have lost anything. Initially, when you make your trade, place the stop loss under your nearest support. So it would have been like around the MA50 area. But then once you're in profit, move that stop loss, move it above, right? That way, if it suddenly turns on you, you're getting out with no skin lost, right? So, what you would have done with this trade here, since it was staying above, based off this strategy, you would have gone ahead and bought after you got that sideways confirmation of good consolidation above the moving averages. You would have gone ahead and bought. Then when it started going up, you would have placed your stop loss above your trade. After another period of consolidation and a successful bounce test off MA50, you would have then moved your stop loss up to here. So it would be beneath that MA50 that it just treated as support. Then when it goes up and up and up and up and up, I mean, at this point, you're being plain greedy if you haven't taken a trade profit on your trade that was at 47,200 when it went up to 65,000, right? That's just plain greedy. But at this point, if you were still in your trade, you'd see it's looking like, see these spikes down and then spike back up where it's like trying to get closer to the MA50. Then you see your indecision candles right here, that morning star. Let me take it off of that, but see that morning star there, the hammer, another morning star. That's serious indecision. That tells me that the run is going to be ending soon. So I would take profit there. Does that mean you would miss out on a $3,000 spike? Yes. But your goal is to get out before the top. You want to trade the momentum. You don't want to try to time the top. You don't want to try to time the bottom, right? Because if you're sitting here trying to time the bottom, all the time, you're going to wind up losing money, right? Because no one can perfectly time the bottom. No one can perfectly time the top. Your goal is to trade the momentum between the two. So, yeah, you would enter your trade here. That's not the bottom, but it's confirmation that we're switching into bullish, because you see that right there just so happens to be where your MA50 crosses above the MA100 again, which is a flip to bullish sentiment. Then even if you still hadn't entered and you wanted to wait until the MA50 crosses over the MA200, then you would have gotten in around the 50,600 region, right? Now it's back into the bullish pattern. Then even still, when you have consolidation here and your MA100 crosses over the MA200, even if you had waited to enter there, you'd be at 54,000. So it's like you can still make money without trying to time the bottom and without trying to time the top. Always just go after the momentum, not the tops or bottoms. Okay. Your goal is to protect the money that you're making. Not like, yes, your goal is to make money too, but your first and foremost goal should be to protect the money that you have. And you can do that by just sticking with the momentum, using your stop losses, actively move your stop loss around. If you want to, as it's going up and going up, if you want to just keep slowly moving it up, keep it a decent little bit away from the candles, right? Because you don't want to have it tap you out just to keep going up. Keep it a little bit of ways away. Like I'll usually keep it, a good 5, 10, sometimes 15% below where the candles are versus where my trade is. So if my trade's here and the candle's here, I'm going to have my stop loss, 10 or 15% beneath that. And then you can move it up, every time it does a spike up, you can move it up, move it up, move it up. That way you're protecting it. Even if you decide I'm not going to exit my trade, I'm just going to aggressively move my stop loss, you can actually potentially capture more of the run that way. But you need to actively be managing your stop loss. I don't want to hear that you were in a winning trade that you didn't move a stop loss around in, and so as a result you wound up losing money, right? I don't want to hear that. It takes 2 seconds to move a stop loss up. You need to be doing that aggressively, or at least keeping it under the most recent support. Even if you want to move it up with the MA50, you can do that because that keeps it far enough away from the candles. And if it breaks beneath the MA50, that generally means that's a good time to be getting out anyway. So if you enter here, once it goes up and you want to put your stop loss underneath that candle's MA50 and just actively move it up, you can do that too. And you would have gotten out when it came underneath it at 61,000. So let me check for any comments. How did you get it to so it showed your stop loss and take profit on the chart? Is that auto triggered when you initiate a trade? Yes, for MetaTrader 4, it will automatically show that on the chart once you enter a trade. So let's take a look here. Let's zoom back in and see how our little trade is doing. We're on the M30. So as you can see right now, it's struggling with resistance at that MA200. See that? See how we started getting some serious selling pressure there. We got buying pressure when it was beneath the MA50 because it wanted to get back above it because it was getting pulled by the close proximity of the MA100 and the MA200. Remember, they have a stronger weight than the MA50. So if it's beneath the MA50, but you know the MA100 and MA200 are close to it, it'll try to pull it up. So right now our trade's in like $77 worth of profit. Let's say we want to put a stop loss, or we should move our stop loss now, right? We're going to move it up so it's beneath the MA100. Now we're only risking a very small percentage of our portfolio because our buy is this top dotted line here and our stop loss is here. But we have and see, once it gets above the MA200, I would move that up. Technically, I could move this up to be right above my trade. And now, with my entry price was $29,686.62. My stop loss is at $29,697.33. Meaning, even if it suddenly flips on me and everything goes upside down, which it looks like it's about to, I will get booted out of this trade with a small profit instead of a loss. So if you're ever faced with indecision, should I, shouldn't I, take my profit, get out of the trade, you can use your stop loss as a hard answer. Just put it above that. Make sure that you're good. Protect yourself and don't wind up losing money when you could have very easily prevented that. It's a habit thing that you need to get into. So make sure it becomes a habit. You set your stop loss and see, boof, our trade closed with $5.11 in profit. And I mean, I think it just tapped our SL to take us out. It's probably still gonna, let's see what it does. You need to see it live action here. See, and then you see how it's acting like there's some kind of support right here. I wonder if on the minute chart, it's getting close to the MA50. Yep. But again, I do not recommend or condone trading on a minute chart. It's not going to be as accurate for you. It's not going to give you the proper amount of data that you need. Like I said, I don't generally enter a trade on anything lower than MA50, and it's a trade that I would have already found by looking on the daily or the 4-hour or maybe the H1 chart, right? I just look for MA30 for entry price. But yeah, do we have any questions? If not, then I'm probably going to bring this a little bit to a close because it's been about an hour and a half and I don't want to take up too much of people's time. I hope that it was a good refresher for some of you who have been here for a while in this trading Discord. Maybe it's something new for those of you who are new to the Discord. Thoughts on other markets like NASDAQ US 30 right now? Can we tank because of them? Yeah, so that's a really good question. For those who aren't familiar, US 30 is the Dow Jones Industrial Average. And yes, US 30 affects Bitcoin. not necessarily in the way that you think. The way it works is if US 30 is going down and it does not recover quickly, Bitcoin will go down. If US 30 still does not recover, then gold will go down. On the flip side, if US 30 is going up, if it does not immediately retrace and come back down, then gold will generally follow upwards. If it continues going up, then Bitcoin will generally go upwards as well. The reason for this is in a market where the Dow is going down, traders and businesses and companies and hedge funds will pull money out of speculative assets like Bitcoin to cover their margin calls. If it keeps going down, then they have to start pulling money out of their safe store asset, gold, to cover those additional margin calls. When it's going up, they will roll profits for safekeeping into gold. If it keeps going up, well, now they've got play money, and they'll put it into a speculative asset like Bitcoin. If you know the how, you'll know the why. Or sorry, if you know the why, you'll know the how. So yeah, that's the why the markets will correlate, but on different time frames. So something just to point out, if you were to look at, let me zoom this out. If you were to look at Bitcoin on the daily chart, so you've got your peak here, your two high peaks, and then you were to look at gold on the weekly chart, got your high peak and your high peak. Yeah, so gold has diverged from it lately due to the hyperprinting of the dollar, but prior to that, you could actually use gold on the weekly chart to determine what Bitcoin was likely to do on the daily chart, because it was the same. See, it's the same patterns. You've got your spike up here, drop down, then it continues running. Bitcoin, you got your spike up here, drops down, then continues running. You see that? And you wouldn't think about it because that occurred in October of 2008 is when that spike's peak was. Then we flip back over to Bitcoin. The spike's peak here was in 2021. So there's a time dilation for that. But it just goes to show you that markets will want to move the same throughout history. Right now, Bitcoin is being treated like a modern version of gold, a digital gold, if you will. You can even see it here. You got your first peak, comes down, then comes back up, comes down before the final peak. Look over at gold. Peak comes down, comes up, comes back down before the final peak. What I'm telling you is that all markets move the same way. Once you understand that, you can compare to other like markets that have a more established history to kind of see what you're currently looking at is going to do or is likely to do. Obviously, it's not a guarantee because of that time dilation, right? Because Bitcoin is younger than gold, right? So it's not necessarily going to be following what it's doing currently, but then again, you could even look at it and you see these two big peaks and the movement in between is almost an exact mirror of this smaller one. Peak, down, middle peak, down, final peak. Then over here, you have peak, down, middle peak, down, final peak. A lot of people will refer that to as the Wyckoff consolidation period. But you can see that across all the markets throughout history, you know, and it's just once that kind of clicks into place and you figure out how to really use that, it can be a bit of an eye-opening moment. I know that it was for me. I felt like I stumbled onto some kind of big secret. Let's pull up US 30 for a minute. Ugh, what happened with that chart? Can we hold on. Properties, color scheme. Yeah, there we go. All right, so we don't have any of our moving averages or anything set up over here, but we can look at this. Let's see, on the monthly chart, weekly chart's decent. So this is US 30, right? And you can see that it began its crash February 16th, right? I believe is when it first started declining for COVID. But then you flip over to gold, and gold, where is it? There's the COVID crash. Gold first started crashing March 8th. So it happened after US 30 did not immediately recover. See that? So US 30 started going down first. Let me bring this back over to front center. All right, so US 30 started going down first, February 6th. March 8th wasn't until right around here, when it had already dropped like halfway. But that's when gold started dropping. Even though gold is supposed to be a hedge, right? People still had to pull money out of gold, their safe store, to cover their margin shorts. Then you see Bitcoin. Where was that? So that was, oh yeah, that was back here. Don't do that. I hate charting on the computer. I prefer using my phone. All right, so 2020, where's 2020? There it is. All right, so Bitcoin, remember, gold started falling on March 8th. US 30 started falling February 6th. Bitcoin dropped off before gold did. It hit its peak and started falling February 13th. Whereas the Dow started falling on, I forget what day we said it was, the 9th, right? 8th or 9th, right around there. So you see Dow went down, then Bitcoin, then gold. Let's zoom in a little bit on that. There we go. I think that's because we're on the weekly right now. Let's go back to the daily for that. There we go. So yeah, I just wanted to point that pattern out to you guys. Take care, Mary. Appreciate you joining in. Yeah, so pay attention to the Dow, because yes, it will affect, I have to go, if this will be on video, can you say your prediction on where we should, in theory, bounce on US 30? Well, that's a tricky one, because here's the thing. Based off of all of the numbers, if the Feds had not stepped in with quantitative easing, US 30 was actually supposed to return down to around the 10,000 region. We only fell about halfway of what we should have fallen according to patterns and moving averages. So it really depends on what they're planning on doing. Right now, though, I will say that the current chart is looking very similar to this right here. Take a look at this. Let's zoom in on it a little bit so you can see it better. Where'd it go? There it is. Switch this to candles. All right, so you see how it's like lower high, and then it kind of starts ranging downward like this. That's actually a pattern, by the way. It's called a broadening, falling, or bleh. But yeah, anywho, beside the point. If you want to learn patterns, go check out the patterns video. But yeah, so that to me looks an awful lot like what it's doing currently. Now, why did it mess up my line? Stupid computer. So to me, that's a little ominous, because as you can see, it had a pretty steep fall off after that lasted for a good while. You know, because it was in this pattern. We had our lower peak, higher peak, and then lower peak, lower peak. And remember, it all moves in patterns. So we have our lower peak, higher peak, lower peak, lower peak. So we're kind of standing in this spot right here. In my personal opinion, not financial advice, but we're standing right here right now, in my opinion, on the general Dow, overall stock market. And then that period lasted from July 2008. The drop started about 2 months later, and to September 2008. And then we did not see that level again. Like, our bottom was in February 2009, so it was many months later, but we didn't hit recovery levels until 2010. So that was a 2-year time frame for recovery levels. And when you consider the current state of the global economics, when you consider how much money the government's been printing, we hit that, you know, we kind of bounce up, go sideways, come down, I would say probably to the 20,000 region. So similar to COVID levels when everyone was panicking. And then potentially up to 2 years to recover, you know, if we're going based off of that pattern cycle that it seems to be repeating. Just as a thought. But yeah. I'm going to go ahead and take one more question, and then we're going to go ahead and wrap this up. I know I don't want to wind up holding people hostage on a Saturday for a prolonged period of time, and I think getting close to 2 hours here. So, but does anyone have a final question before we head out? I want to thank you guys for coming out. Oh, has Charity been posting questions in a different room that I've been missing? I don't see anything. Yeah. But anywho, I wanted to thank you guys for coming out. You know, and I hope that it was a good little refresher. For those of you who have been here for a while, maybe there's some new tidbits of knowledge in there if you're new. I do highly recommend that you watch the actual instructional videos over in the videos training room under the Learning Center category. That one, there's a pattern video, there's a strategy video, and it goes a little more into the nitty-gritty about how the strategy and how the patterns work, how to calculate patterns, and all that kind of fun stuff. So this was just kind of a general overview, and I wanted to reassure you guys that the market being crazy right now is nothing new. It's expected. If you weren't here during the first part of the video where I went over all of that, you know, this is nothing new. This was expected. It's the same cycle Bitcoin's been following since its inception. So don't panic. Look for your entries. which we talked about that, what your calculated entry region should be, based off the weekly chart of Bitcoin. So, just be smart, use risk management, use your stop losses, and for those who want to practice the leverage trading, you can download MetaTrader 4, and then you can actually sign up for a demo account with Hugo's Way. That's the broker that I like because they have pretty decent spread on gold, so you're not paying a whole bunch for no reason on your trades. So but I like them. I also like them because they're overseas, so they're not regulated by the U.S. But yeah, so you can create a demo account there, and you can practice with it a little bit if you want to practice the leverage style trading. Shoo, don't do that. Post those links. Yeah. Let me grab that real quick. So this is Hugo's Way. That's the broker that I use. At the top right of their webpage, there's the option for download MT4. It lets you use it on your computer, which is what I've been showing the charting with you guys currently. And then you can create a demo account very easily. And I highly recommend, no matter how confident you're feeling, you make a demo account. No, unfortunately, you cannot retroactively short your portfolio over the last month. Anywho, you can make, no matter how confident you're feeling, or how knowledgeable you are with spot trading, if you are going to practice leverage trading on the Forex broker, I want you to make a demo account. I want you to trade it until it grows 3x overall. So if you start a $10,000 demo account, grow it to 30,000. Then I want you to delete it and do that 2 more times, because everyone blows up their first trading account on Forex. Everyone. That is a rule. It will happen at some point, because first you need to build the habits and the discipline. Leverage trading is a whole different or ball from spot trading, right? If you're spot trading, you can just hold forever until eventually you're in profit. If you are leverage trading, you don't have that option. You will eventually lose yourself on that. If you don't have the patience to wait for a calculated entry. So by doing those 3 demo accounts where you grow them to 3x their value, delete it, do it again, delete it, do it again, delete it, what you're doing is you're building up the discipline necessary to do it for real successfully. So that's just my little tidbit for you there. I see a question. Is this what you use on MetaTrader to get Bitcoin? Hugo's Way does trade cryptos. I believe it's, let me see which cryptos they have. They have Bitcoin. They have Dash, if you still care about that for some reason. They have Litecoin. They got Neo. They have Ripple. So they have your XRP. They had Luna on there, but that's not on there anymore. Yeah, so they have Ethereum as well. There's not a whole lot of cryptos on there, but there's enough for you to, leverage trade some cryptos. At least like the blue chip ones. If you're looking to do more cryptos, you would have to use like Binance Futures or something like that. But anywho, I appreciate you guys all coming out. If you have any questions, Bybit, honestly, haven't really looked into them. You are welcome, Shu. But yeah, I mean, if Bybit offers like standard future trading, then they'd probably be okay. I'm always hesitant for those ones like Binance or whatnot because they have aggressive stop hunting that takes place. Like they can actually see where you put your stop loss, which I think is absolute bullshit, right? So it's not uncommon for a lot of people to have their stop losses tapped and then it runs, right? So it's like just enough to take you out so you don't make money off the run. So that's why I generally don't like a lot of those various ones where the trading takes place within their system. See, with Hugo's Way, I do the trading on MetaTrader 4. I don't do the trading in their system. They're just the broker. So it's not like they're seeing my stop loss and actively trying to hunt it, right? Because I'm not taking money from them. I'm taking money from the Forex market. So just something to bear in mind, something to consider. If you find yourself trading on Bybit and like your stop loss just always seems to get hit and then it winds up going the way you thought it was going to go, just be aware of that. That's probably what's going on. But yeah, thank you guys for coming out. If you have any additional questions, we do have that questions room. Feel free to post them up in there. I will be checking it periodically throughout the day just in case you guys have any side questions that you come up with when you're thinking about it. But yeah, those of you who are new, welcome to the server. Hope you stick around. There's a lot of very well-educated individuals here who have been with me from the beginning. Oh yeah, no, we are recording it. There's like 3 of us who are recording it. So yeah, this session was recorded. I may have to wind up uploading it to YouTube because it's probably going to be much too long to upload onto Discord, especially since there's video along with the audio. But yeah, so thank you guys. Have a great rest of your day, and I'll try to do these once a month moving forward, and going over like specific topics. That way it keeps it shorter. But I know I've been neglecting a lot of you guys lately with all the work I've been doing over in Parrotly, and I want to slowly shift on changing that. So yeah, I'm gonna look at trying to do these once a month, with like specific topics. So, all right. Thank you guys. Appreciate you. And you have a good rest of your day.